Just buy good companies and hold them forever. You've probably heard it 1,000 times. From your parents, Warren Buffett quotes on Instagram, from every finance influencer on the internet. And for a long time, this was all true. But the market that made the buy and hold actually work, it doesn't exist anymore. And most people haven't caught up to that yet. Now, before you click away, I'm not saying buy and hold is dead for everything. For an index like the S&P 500, emerging markets, it still works. Over time, the market goes up. That's math. That's real. And later in this video, I'll tell you exactly how I think about the index versus individual stocks, because that distinction matters more than almost anything else in investing. Individual stocks, the ones you picked yourself, the one you bought because your friend told you about it, or the one you saw on YouTube. Buy and hold on those will ruin you. And in this video, I'm going to show you exactly why with real data, and then I'll show you what the professionals actually do instead. My name is Felix. I became financially independent before 30 through investing. Not through a startup, not through inheritance, through a systematic method. I've spent over 15 years in the markets, and I've taught over 1,000 students how to invest through systems instead of gut feeling. And this single most expensive idea that I see a lot of people try to cling on to is that patience fixes everything. It doesn't. Not anymore. Let me show you why. Buy and hold worked beautifully for about 40 years, and there's a reason why. A very specific reason. From the early 80s to 2021, interest rates went in one direction. Straight down. From over 15% down to zero. And when money's that cheap, everything goes up. Stocks go up, property go up, even mediocre companies go up. Why? Well, because there's nowhere else for money to go. When rates are zero, a company doesn't need to be great. It just needs to exist and have a story. Investors pile in because the alternative, sitting in cash or bonds, basically pays you nothing. This is the environment that created the just hold forever advice. And it was genuinely good advice in that specific environment. So your parents, well, they weren't wrong. They were just playing a game that no longer exists. Three things changed, and they changed roughly at the same time. First off, money got expensive again. Interest rates went from 0% to around 5%. And when you can earn 5% risk-free, every stock suddenly need to justify why you as an investor should buy it or take the risk of owning it. And a lot of companies can't justify that, and their stock collapse. Not because the company got worse, but because the math around it changed. Number two, competitive advantages are disappearing faster than ever. The average company used to stay in the S&P 500 for 33 years. Today, it's around 15, and it's shrinking. Half of the current S&P 500 companies is expected to be replaced within the next decade. And you probably guessed it, AI is accelerating this further. Business moats that lasted for decades now lasts months. The company you bought and planned to hold forever might not even be relevant in 5 years. Number three, the market is more concentrated than ever. The top 10 stocks in the S&P 500 makes up for more than 40% of the entire index. That's higher than the dot-com bubble. So when people say the market's up, well, they don't mean that 500 different companies are doing great. They mean 7 companies are doing well, and they're dragging everything else along. The other 493 stocks, well, they're in a different reality. And if you're holding stocks that aren't in the top 10, the index going up means absolutely nothing for your portfolio. Put those three forces together, and what you get is a market where the patient, the passive, and the just hold it approach that worked for decades is now actively dangerous when applied to individual stock picks. Let me show you what this looks like in practice. I'm going to go deep on 2 specific stocks because the lesson is in the details, not in rattling off a red list of numbers. Take a look at Zoom. This wasn't a meme stock. It wasn't speculation either, because during the pandemic, every company on earth was using Zoom. Revenue didn't just grow, it quadrupled. The product was genuinely dominant. People bought the stock at $400, $500, and it made complete sense at the time. Peak price, almost $600. Today, about $100. A decline over 80%. But here's what matters. Zoom isn't a bad company. Revenue's still high, around $5 billion a year. And the product still works. What happened was that the reason to own the stock disappeared. Microsoft bundled Teams into every single Office subscription. Google Meets improved. The moat, which was basically our product works, theirs doesn't. It evaporated in 18 months. And buy and hold investors had no system for seeing that. No trigger, no signal. They just held because that's what they were told to do. And they watched around 82% of their money just disappear while telling themselves it'll come back. Another one, PayPal. They basically built the infrastructure for online payments. And its peak during mid-2021, $310 per share. Today, around 40, an almost 90% decline. And this is a company still doing over $30 billion in revenue every year. It's not bankrupt. It's not necessarily failing. It's just not worth what people were paying for it. So what happened underneath? Apple Pay launched. Shopify built its own payment processing. Block, Stripe, Klarna. The competitive landscape fragmented. The moat that PayPal had as the default payment layer of the internet as a whole, it got chipped away from every direction. And here's what's painful, because if you look at what large investors were doing early 2022, meaning the pension funds, the hedge funds, the people managing billions, they were already reducing their positions. The smart money saw the competitive shift and rotated. Retail investors didn't. They held because that's the only strategy they had. And this is the core problem. Buy and hold has no mechanism for recognizing when the reason you bought the stock no longer exists. It's a strategy with an entry but no exit. And in a market that moves this fast, a strategy without an exit signal is a strategy of slowly losing money. So if buy and hold doesn't work for individual stocks anymore, what does? Here's how I think about it. Your portfolio has 2 layers, and each layer follows completely different rules. Layer 1, the index. Layer 1 is your foundation, broad market index funds. The S&P 500, emerging markets, whatever gives you exposure to the entire shebang. This is where the buy and hold approach still makes perfect sense. Why? Because index replaces its own losers. When a company falls out of the S&P 500, it gets removed and a new company takes its place. You never have to make a call yourself. The index does the selling for you. Over the last 100 years, the broad market index has returned around 8 to 10% per year. Not in a straight line. Some years it's up 30, some years down 20. But over decades, the trajectory is up. And you capture that by doing literally nothing. Just by buying consistently and not touching it. This should be the majority of your portfolio. I'm talking 70 to 80%. This is the part you don't think about, you don't stress about, you don't check it every morning. It just grows slowly in the background. And the mistake people make is that they apply index strategies to individual stock picking. The index can hold forever because it self-corrects. Individual stocks can't. That's the distinction that most people miss, and it is the distinction that loses them the most money. Layer 2, individual stocks. Layer 2 is your active allocation, 20, maybe 30%. This is where you pick individual assets. Stocks, for example. And this is where you need a completely different operating system than the classic buy and hold. Here are the rules that I follow. Rule 1, have a thesis and write it down before you buy. And absolutely not, I think this stock will go up. An actual thesis. One sentence for you. Why does this company deserve your money right now? What is the specific reason that you believe this stock is undervalued or has a catalyst ahead of it? If you can't write that sentence, you don't buy the stock. Period. And here's the critical part. You also write down what needs to change in order for you to actually sell. And you do this before you buy, not when you're panicking, not while the stock's down 40% and you're trying to rationalize holding it. You define the exit before the entry. Rule number 2, define your exit triggers. I have specific triggers that tells me when to sell. The thesis breaks, meaning the specific reason as to why I bought the stock in the first place, no longer exists. The competitive landscape shifts, like what happened to Zoom and PayPal, the institutional money starts exiting, or the macro tailwind that I was counting on. Maybe it reverses. When a trigger fires, I sell. No, let me wait and see. The system tells me what to do, and I execute. And this is basically what separates investing from hoping. Hope says, it'll come back. A system says, the reason as to why I bought it in the first place is gone, so I'm out. Rule 3, rotate, don't marry. Professionals don't fall in love with stocks. They own a stock for a reason, and when that reason disappears, they move their capital to where the risk to the reward ratio is better. This isn't day trading, this isn't flipping positions every week. It's basically re-evaluating your holdings every quarter and asking yourself, if I didn't already own this, would I buy it today at this price? If the answer is no, that's information. Act on it. Rule number 4, size for asymmetry. Size your positions accordingly. So if you are completely wrong, it's a bad day, not a bad year. And if you're right, well, then it's meaningful. The goal is to keep yourself in the game long enough for the systems to work. So, what we just discussed is the operating system, the rules for how you're managing individual stocks. But how do you find the right ones in the first place? I use a 4-point filter to begin with. The first one, out of favor. The stock is either hated or ignored. If everybody's making YouTube videos about it or it's in any way trending on social media, we're probably too late. The risk-reward ratio is probably off. The best opportunities are the ones that nobody's excited about. Number 2, a real business, not just a promise. Actual revenue and a product that people are paying for today. Not a company that might be profitable 2028. No thanks. One that's actually generating money. Number 3, structural tailwind. A macro force that's going to push the demand up for what this company is capable of during the next 3 to 5 years, regardless of what happens in the stock market tomorrow. AI infrastructure, defense spending, energy transition, aging demographics. These are the currents that move the market over years, not just news cycles. 4, smart money accumulating. Institutional investors, the ones managing billions, when they're quietly building positions. When the people that are doing this professionally start buying something that nobody else is watching. I pay very close attention. That's the checklist. Every stock has to pass all 4. And just as importantly, when one of these factors reverses, that's my sell trigger. The filter works in both directions. So let me bring this together. The index, buy and hold, still works. Will probably always work. Make it the majority of your portfolio and stop overthinking it. Individual stocks, completely different game. You need a thesis before you buy. You need exit triggers defined in advance. You need to rotate instead of pray. And you need a filter for finding the right opportunities in the first place. That's what replaced the buy and hold for me. Not because I think I'm smarter than Warren Buffett, but because the market that Buffett built his fortune in, the 40-year rate decline, the decade-long moats, the slow-moving industries, that market's gone. The market we're in now definitely rewards a system. It rewards people who know why they bought. It rewards people who know when to sell. Don't confuse patience with paralysis. If this made sense to you, subscribe. I'm building this channel to teach people how to invest with a system. Not gut feeling, not tips, not blind hope. Just a method. Just a method. Drop a comment and tell me, what stock are you currently holding that you can't explain why you're holding it? Be honest. I'll read them. See you in the next one. Peace.